Hare Krishna. Ekbar, once again, welcome to my channel, Purposeful Prosperity. So, as we are going through this book reading of Little Book of Common Sense Investing, where we are trying to extract the wisdom from each of their chapters. So, today we are going through the chapter number 4, where it explains that how most investors turns a winner schemes into a loser scheme. And the reason for this they have been given is the relentless rule of arithmetics. So, a few of the points that have been explained here where it says the simple and undeniable realities of investing. And the major points which have been given in this chapter are the returns of investor as a group must and will and do fall short of the market returns by an amount precisely equal to the aggregate amount of all these cost, additional cost, which we have learned in the chapter 1, which are called helpers. And these costs involves like fund management and operating fees, which is normally in the mutual fund industry known as expense ratio. Then we have a portfolio turnover ratio, which is normally the hidden cost and which normally a retail investor don't care much about. Then we have the opportunity cost. This is again a hidden cost where most of the equity funds holds between 5 to 10% of cash reserve where they are not earning any sort of returns. Then we have the sales load, the legal and the advertising fees. We also have brokerage commissions and fees. And when mutual funds which are really large and doing a selling at a large uh, fund basis, then definitely there is a bid ask which is getting spread. Also, there will be a market impact cost also. So these are few of the major costs, and all these costs are the prime reason that a retail investor is turning this winner scheme into a loser scheme. S- And the important thing with all these fees is that we pay the above fees whether our returns are positive or negative. The all-in cost of equity fund ownership can come close to as much as 2 to 3% per year. So that really cost matters. And with our compounding episode, we really understand that even a zero point 0.5 or a 1% difference for a very long duration creates a huge difference. And here we are talking about close to 2%. So this cost really matters. So before cost, beating the market is a zero sum game. And after cost, it's a loser game. That's the conclusion uh, Mr. John Bogle is trying to give because we understand that overall, it's not the mutual industries or financial influencers which are creating the wealth. It's the companies who are through their earning growth and the dividend yield, we are getting the returns. And if a one person is getting an extra share of that return, then there is another person who is going to lose the equal amount of return. So before the cost, beating the market return is a zero sum game. And if you have all these costs, which we talk about in the previous slides, which can be between 2 to 3%, then definitely we are playing a loser's game. Further, Bogle is explaining that the grim grim irony of investing then is that we investor as a group not only do not get what we pay for, we get precisely what we do not pay for. So if we pay for nothing, then we get everything. So that's very important thing. And see the kind of words that he has used. So if we are going to pay some cost to get some market beating returns, unfortunately we are not going to get that. But if we don't pay, so if we invest in low cost index fund where we are not paying anything for beating the returns, then we are getting the full return, a fair share of return from the stock market. That's the Bogle suggestions. Then Bogle in the further in the chapter is explaining about the principle from Mr. Louis Brandeis, where the Louis Brandeis is saying that obsessed with the delusion that two and two makes five, a retail investor fall at least a victim of the relentless rule of humble arithmetics. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. See, this is very important. 2 plus 2, 5. So, how does this apply in an investing world? See, here we are saying that I am going to pay a mutual fund or a PMS, a 1% or a 2% expense ratio. Then all these additional costs that I am going to have, and combined, we have seen that it can have an impact of 2 to 3%. And if I am saying that I am going to beat the market with this additional cost, then this is something similar saying that 2 plus 2 equal to 5. So I am saying that my my mutual fund manager is going to produce something extra from the market, which unfortunately, guys, they cannot. So that's the humble rule of arithmetic. So if you really understand the arithmetic, which is the mother of safety, then a retail investor should not make this mistake of assuming 2 plus 2 is 5. In fact, from the market share, it should reduce the cost, and that is what his real return is. That's the real arithmetic, which will be less than the market return. So be careful, investors, with this humble rule of arithmetic. Then further, Bogle is saying that it's amazing how difficult it is for a man to understand something if he is paid a small fortune not to understand this. And how do we do this? Let's just understand this. So it's hardly in the interest of our financial intermediary to encourage their investor or client to recognize the obvious realities. Indeed, the self interest of the leaders of our financial system almost compel them to ignore these relentless arithmetic rules. See, if your financial advisor tells you that you simply invest in an index fund and you forget it for all of your life, then do you think that his business is going to survive? Because every time if you go to him, he's going to say, okay, keep on holding, keep on holding. But that is not how he's going to earn the money. Then you have mutual fund distributors. Uh, there are many financial influencers and all those. There are many YouTube channels which are generating a lot of money just by running some live sessions of 2 to 3 hours, and people are asking so many questions there, and they are giving some random answers. In fact, some of them are trying to help also. But we really need to understand that it is not in their benefit that if they advise you to always invest in an index fund, they are going to say, oh, you put some percentage in a large cap, you put some in a small cap, mid cap, and if something is not performing, okay, switch from mid to a small cap, then from small to mid cap. So all that jugglery they have to do, because if you are paying some fees to your financial intermediaries, then definitely in order to justify that fees, they are going to force you to do some action. And in the previous chapter, we have learned that for an investor, it's much better to ignore all that sound and stick to his plan of long term investing using a low cost index fund. So, further few of the key takeaways from this chapter is that our system of financial intermediation has created enormous fortune for those who manage other people's money. See, that's a very important thing. I'm not sure how many of mutual fund investors have become really uh, uh, it really created a big wealth, but definitely all these mutual fund managers or the financial intermediaries or the PMS owners, they have created enormous fortunes because what they are doing, they are simply managing people's money. So there is a big share of market share which is supposed to be distributed among all retail investor. It is taken from them and being distributed to all these financial intermediations. And that is what we need to save. This is a huge cost. So as an investor, you must look after your self interest. That's very important. Many people don't know what is their self interest, and that is where Bogle is trying to explain that our self interest is to save all these additional costs and go for a low cost index fund. Then further in the chapter, he's saying that only by facing the obvious realities of investing can an intelligent investor succeed. So we really have to understand that what are the realities of investing. So when we understand all these things, why the different peoples are trying to give different kind of gimmicks. If you go to any of the channel like we see have the CNBC or this kind of a stock market channels, whole day all sort of peoples are coming, and if you see everyone is giving different sort of advices because it's their interest, not your self interest. So that is what an intelligent investor is. He should be caring about his self interest, and once he understands about these realities, then only he can become a successful investor. So mutual funds managers are competing with one another. So when one buys a stock, there is another mutual fund owner who is going to sell it. So it's not that when mutual fund buys a stock, they don't get it from a retail investor because they really buy in a bulk. So definitely, when one mutual fund owner is buying, there is another mutual fund who is selling. So what is the net gain for the fund shareholders as a group? There is no gain. In fact, there is a cost involved. There is a loss of equal to the transaction cost that pays to those helpers in that buying and selling. So that is what we have to understand. So there are many hidden costs involved here, which a normal retail investor doesn't know. And that is where he's turning a winner's game into a loser's game. So investor pay far too little attention to these costs of investing. Now the question can be asked that in what scenario they are not paying this attention. And so here Bogle is trying to especially saying that there are three main conditions where they really underrate their importance of this cost. So when the first condition is when the stock market returns have been really high. When the stock market is giving very good returns, then even if they are losing with some percentage, they don't care about those costs because they have come in a market with an assumption, let's say 12 to 14% of return. And if they're getting some 18 to 20% of return, they will be too happy with that thing. And in that happiness, they are completely ignoring this cost of investing. Second thing is that there are many investors which are focused on short term returns alone. And when they focus on the short term returns, then the impact of this cost will be visible in a very long term. So, in a short term, this cost doesn't hurt much to a retail investor. And that's also another reason. So, they don't look for these costs. And the third and the last point is that when there are many costs which are hidden, we understand that there is an opportunity cost, a, a portfolio turnover cost, there will be a brokerage cost, transaction cost. So, there are multiple costs which are not getting captured in your expense ratio actually. And all these costs combined together can impact you up to 2%. And this 2% of difference over a long term can really take most of your wealth. I hope it will be difficult to understand that how much 2% difference can make. So that's something further explained in this chapter. So where Bogle is saying that in the investment field, time does not heal all wounds. It makes them worse. So when returns are concerned, time is your friend. But where costs are concerned, time is your enemy. So let's just understand this further. So here Bogle is giving a simple example where he's saying that a $10,000 is invested for over a 50 years because he always talks about a long-term investing. And he's saying that a market return is, let's assume, 7% before cost. And he's saying that if the fund is returning 5% because there is an additional 2% of cost, then we can see from this graph that if you look at in the 10-year thing, there is a slight differences there in the returns. So that's something a developer or a retail investor will ignore. But if you look at 20%, 20 years, then the difference is getting widened. Look at 30 years, 40 years. Can you see that? The amount is all in the 40 years, amount is almost become half. And look at 50 years, you got just the one third percentage. So your wealth is really eroded just because of this 2% additional cost. Now you may say that, okay, my funds are really taking very low fees. So this cost will be coming 1%. Even if this 1% is there, you are going to have a huge impact here because we are talking about a long-term investing. In India, normally people will get a job, I think, at the age of 22 to 24, and they work up to 55, 60 years of age. And in India, we normally assume a normal uh, retirement age or the age of your death will be close to 85, 80, 85. So you can see that we have definitely some 50, 55 years of our investing. And if there is something you are planning for your next generation, then definitely this compounding can be further impacted. So these costs really matters. So that's the full aim of this chapter. Just trying to explain the retail investor that that it is all these costs only which are turning your winner game into a loser's game. So Bogle further says that over the long run, the miracle of compounding return is overwhelmed by the tyranny of compounding cost. See, we all understand that compounding is the eighth wonder. But see, here Bogle is adding additional point here. Here is saying that your compounding returns are overwhelmed by the tyranny of compounding cost. And if you really want to see that, then look at the next slide. So this slide really present the impact of this 2% additional cost. And you can see that how investor returns are getting reduced. See, in 10 years, a 17% of his wealth is being gone into that 2% additional cost. If you look at 20 year, 30 years, in a 30-year, almost 43% of his wealth is gone in that cost. And if you look at the 50 years, my dear friends, 61% of his wealth is gone in that 2% additional cost. Can you see that? 61% of the wealth. That's really a huge amount. So in a 50 years, you can see that more than half of your wealth is eroded because of these additional costs. So we really have to pay some high attention on all these additional costs. I think I know that there are many big investors or retail investors who are having huge money. They're trying to go for this PMS route, which sometimes charges more than 2% as an expense ratio itself, plus all these hidden costs. If you include, then just think of it that in a 50-year gap, how much difference these additional costs can make in order to get your cumulative return. So Bogle is further adding that our fund managers sitting at the top of the investment food chain have confiscated an excessive share of the returns delivered by our financial markets. And the fund investor, eventually at the bottom of the food chain, has been left with a shockingly small share. So here Bogle is saying that there is in a food chain, if you take, then the fund manager is sitting as the top, and he is getting the maximum benefit because of the how our financial market works. The fund investor who is actually putting all his hard-earned money, taking up all the risk, he is getting the smallest share of his benefits. So that is what he is trying to educate us, trying to understand, trying to give us an understanding that how these financial market works. Because once we understand these working, we can become a better investor. So further, Bogle adds that cost makes the difference between the investment success and the investment failure. So we always talks about returns. No, my dear friends, it's the cost also that can make a huge difference, and it can turns your investment success into an investment failure over a very long duration. So now it's up to us that we want to make we want to choose the side of our investment success, or you want to choose the side of investment failure. Bogle is further adding in the chapter where he says that, in short, the humble arithmetic of investing, the logical, the inevitable, and the unyielding penalty accessed by the investing cost has devastated the return earned by mutual fund investors. See, that's the humble rule of arithmetic, which is logical, inevitable, unyielding. These investing cost is a penalty, and that is really taking up all the returns which a mutual fund owners is supposed to get. So that's why we have to be really careful about these additional costs of these additional helpers. See a quote from the Peter Lynch. He's saying that the looking at the data in a recent time, he's saying that S&P is up 343 points for 10 years. So that's a four bagger. But the general equity funds are up 283%. So it's getting worse. The deterioration by professionals is getting worse. The public would be better off in an index fund. See, Peter Lynch, there are so many people who are getting inspired by reading his books. See what he is concluding looking at the current scenarios. Because he knows that there are many professionals who are not able to beat the index fund. And that's why he's advising public that it should be better if we stick to an index fund. That way we can do much better than an average investor, average retail investor. Then Mr. John Fossell, who's the chairman of the Investment Company Institute, uh, he's saying that the people ought to recognize that the average fund can never outperform the market in total. A very strong instruction where he's trying to say that we will not be able to figure out a mutual fund who can beat the market. They can never outperform the market. So when you look at the funds, I would say I think you look at the fund category average. And that's where you can see that the category average will be always below the market returns. Why? Because of all these additional cost. And there is a one winner, there is a the loser also. Plus there is the impact of cost. So all these mutual fund combined together, they are playing a loser's game. And we should not play the loser's game. We should play the winner's game by sticking to a low cost index fund. Then for further, Mr. Jim Cramer, he's saying in one of his quote, after a lifetime of picking stocks, I have to admit that Bogle's argument in favor of the index fund have me thinking of joining him rather than trying to beat him. Bogle's wisdom and common sense are indispensable for anyone trying to figure out how to invest in this crazy stock market. See, Jim Cramer, whole his life he has been investing, not through an index fund. But see, he really is appreciating the Bogle's wisdom and the common sense. And investing is all about common sense. So when such a big investor is appreciating the Bogle's wisdom, why real investor like us who are new to the market, why don't we take the Bogle's wisdom of some 45 years of investing and imbibe in our investing style? That will save us from lot of these unwanted noise, and we can really make some good wealth. Then Mr. Cliff Hessness, he's further saying that market cap based indexing will never be driven from it deserved perch as core and deserve king of the investment world. See, index investing is named as king of the investment world. It should not be a small part of your portfolio. It should be the king of your portfolio. It is what we should all own in theory, and it has delivered low cost equity return to a great mass of investor. The now and forever the king of the hill. So index investing is going to be the king of the hill. So this king should always be there in our team if we really want to play a winner's game. That's as wise Mr. Cliff. So with all these things in this chapter, we can finally conclude that it's these additional costs, be it in a stock market investing or be it in a mutual fund investing, they are turning our winner's game into a loser's game. And if we really want to play the winner's game, then we have to stick to a low cost index fund in order to get our fair share of market. And if we don't make this mistakes of giving this additional cost, then that's the way we are playing a winner's game. So thank you once again for your time. I hope you have some nice learning with this chapter. If you really like this kind of a content and if you think this is really helping you, then feel free to like, share, and subscribe to my channel Purposeful Prosperity. And I will see you again with the summary of the next chapter. Thank you once again. Hare Krishna.